the title is CRE is vulnerable, but please don't overlook the details. This is, we were talking about, there's a difference between, are your properties vulnerable? Are those in as an investment, or is it creating vulnerability? And I think for the office properties, both. Banking turmoil, rising interest rates have put CRE in the spotlight, specifically the office sector, just like kind of we talked about. The GDP has been revised out to 2.6%. PCE growth has decelerated to 0.3%. Inflation expectations have declined sharply. I italicized this in my notes because it's important to note that maybe if inflation's going down, is that going to? I still don't think that we're going to snap our fingers and get low interest rates again. No. And there is so it's still maybe some big troubles on the way just because of the lagging effect of all these loans coming due.
Yeah, I mean, I think we've been in kind of a stagflationary environment for the last 6 months, and I think that we're really going to experience some stagflation of some moderate inflation, but just some anemic growth for a period of time. Now, how anemic? That's yet to be seen. We're starting to see the cracks. I know we've seen, wages have been growing. I think we get some hourly wage information tomorrow that's going to be released on Friday. Mm-hmm. It's going to show some wage increases. Yeah. But we've been adding less and less jobs, and some of the recent data has shown, hiring has slowed, some weakness. Mm-hmm. Still tight, still strong, but a weaker job market, which is what the Fed wants to see, and it's a lagging indicator. So we could. This week, and again, it's going to be different 3 weeks from now, Matt. Yeah. But right now, everyone's like, no, recession is certain.
Yeah.
3 weeks from today.
Yeah.
Mark our calendars. No more recession in sight, and it's all like yield. You're looking at the yield curve.
Yeah, it's interesting to see how much we've been talking about interest rates and the vulnerability and stuff, and we've been, talking about maybe the effect on the greater economy. More and more people are talking, especially the tech sector. And it's not just like this first wave of layoffs, but these high interest rates are a completely different environment for tech companies that used to just be able to kind of grow their way to valuation, but now they suddenly don't have, like, the runway is gone. Then no one wants to make a decision with high interest rates. And there's going to be, I see, and this is
I heard Google had a layoff 40 masseuses recently.
We'll got to talk about that afterwards.
Yeah.
But I do, these tech companies are having Facebook.
Sorry, I was going to say, I don't think actually masseuse is the proper term. I think it's massage therapist.
Oh, okay. All right.
Doesn't mean to offend it.
Yeah. Facebook has this era of efficiency. This is, I think, maybe a different era. You think back to the past 15 years, was the low interest rates and tech, and you could have all the amenities. It's Silicon Valley. The show Silicon Valley.
Exactly. It's like, that doesn't make sense. Like, that never made sense, right? Everyone's like, what?
I know.
Free sushi, massages, everyone gets to just not work at the same time. Like, it didn't make sense now, and now it's just like, what, chickens are coming home to roost, to use the term.
And for the VC or for an investor, sometimes it would make sense if you have low interest rates that you have that money that you can kind of wait and see which one of these investments is going to work, or you have a lot more wiggle room. And that's what seems like the whole economy had a whole lot more wiggle room. Now you make one mistake, like I said, one scratch in a bank,
it's real,
and then you've got you're bleeding. And you can't staunch it unless there's a crisis. And that's why I think this office situation, even if it's a small scale crisis in the office market in a certain city or a certain bank, it could, create a little bit of a contagion effect. And this report from Moody's, it's actually a pretty good size report for some of the stuff that Moody's typically puts out is a little more briefs. They have a section on vulnerable office markets, and they talk about the metros with the highest and lowest pre-1980s class office stock. And so, which are the places with the old buildings, which are the ones that are the most vulnerable to an economic slowdown too. And, this is good information for office investors, but it's also, I think that it's worth talking about this specific real estate sector because it could have such an outsized effect on the market. And, maybe I'm being overly dramatic, but it seems, it's a lot of value are held in this, and if that value is destroyed, then I don't think that we're going to get out of this without some.
And it's a lot of institutions too.
Yeah.
Institutions have always have historically liked investing in office buildings, especially in prime markets and CBDs and insurance companies, and maybe those institutions can better weather the storm. But what I'm curious, Matt, is so what's the fallout? Because obviously it's not going to be completely contained.
Yeah.
We're not going to be able to put office in isolation. There's going to be some bleed over. The macro economy, we kind of talked about who knows, the black swans, but multifamily itself, is it going to get lumped into, office, Matt? I mean, what are your thoughts on how take the fundamentals of multifamily out, other than like on strong footing, other than just interest rates, but how do investors view multifamily in the context of offices? Does multifamily look that much more attractive, or is like all CRE gonna look dangerous and risky?
See, I bet if it causes anything, it could cause a general economic downturn or something like that, where a lot of people have a lot less money now, whether they want to invest or not.
And just less credit.
Yeah, and rather than like being part of people's decision-making process, it may not be as much of like as an alternative or not, but it may just be one that just kind of caught in the crossfire. And maybe multifamily has to deal with stricter bank lending terms because, they're trying to kind of like mitigate risk or tighten their belts. Yeah, keep that plane away from me. But yeah, like I think that's it.
Like I'm wondering, like, are there gonna be like office investors who are gonna be like, I have to sell my multifamily deal because I need to raise cash for.
Oh, that would be great. Yeah. But when it comes
to be good or not, I don't know. Depends on if you're.
Yeah. When it comes to demand, though, I think that demand from renters, I think that we're in a pretty good spot.